In 2023, the amount of assets managed by passive investing strategies like 401k retirement plans surpassed the amount of assets managed by active investing strategies like hedge funds. And the result is that major stock indices such as the S&P 500 have been grinding up and to the right as passive capital continues pushing markets higher, automated buying that doesn't stop, at least in theory. In practice, the dominance of passive flows could set the stage for a market crash worse than anything we've seen in modern history. And that's why today we're going to tell you everything you need to know. My name is Nick, and make no mistake, this is a video you can't afford to miss. I'll start by saying that nothing in this video is financial or investment advice. It's educational content intended to inform you about how passive investor flows are affecting the markets in a way that no one can understand. And if this is the kind of content you enjoy, then smash that like button to let us know, and subscribe to the channel and ping that notification bell so you don't miss the next video. Now let's start with some definitions. As the names would suggest, passive investing involves gradually investing in a basket of assets over a long period of time. And this basket of assets is typically a combination of stocks and bonds, like 60% stocks and 40% bonds, hence why you hear about the 60-40 portfolio everywhere. The goal is to buy these assets for years or decades, and only sell them when you retire or whatever else. Now, what's interesting about passive investing is that it assumes that the markets are efficient and rational. It assumes that investors already know everything there is to know about the stocks and bonds being bought and sold, so the current price already reflects everything that will happen. As such, this means that there is no point in actively trading because there are no extra gains that you can actually hope to make. Naturally, active investing inherently assumes the opposite, that markets are inefficient and irrational. In practical terms, this means that sometimes the price of stocks and bonds trade significantly above or significantly below what they're actually worth for whatever reason. As such, you can make bigger gains than passive investors if you're able to accurately identify and trade these dislocations. If this is the first time that you hear about these assumptions, chances are you're thinking, well, yeah, of course markets are irrational, so active investing is the way to go. Well, that's what everyone thought for a long time, which is exactly why almost all assets were actively managed for most of history, at least in the US. And this changed in the 1990s when investors started realizing that most active managers sucked. Besides the fact that active managers often had high fees, most would also consistently underperform the S&P 500 index. Logically, investors allocating to active managers decided to just put their money into the S&P 500, especially since it also had much lower fees. By 2005, passive investors overtook active investors as the dominant investors in US markets. But as I mentioned in the introduction, it wasn't until 2023 that the total amount of money managed by passive investing strategies overtook the amount of money managed by active investing strategies. And what's fascinating is that the dominance of passive versus active investing seems to have been orchestrated. What originally began as a logical decision eventually became something that was basically mandated. You see, in 2006, US President George W. Bush signed the Pension Protection Act of 2006. This law is considered by many market analysts to be the most significant as it relates to passive investing. And that's because it essentially set the stage for automatic lifetime investing for workers in the US via defined contribution plans, which included stuff like 401k retirement plans. And the act went into force in 2008, conveniently just in time to support the markets after the Great Financial Crisis. But here's where things get a little bit crazy. If you've heard about the Pension Protection Act, then you've likely heard that it mandated companies to automatically enroll workers in these passive investment plans. This is true, but it wasn't because of the Pension Protection Act. It was because of the Secure 2.0 Act, which was signed into law by Joe Biden in 2022. Believe it or not, but it went into force in 2025. In other words, since the start of 2025, everyone who gets a job in the US effectively has a portion of their income automatically allocated to passive investment strategies unless they opt out. In turn, most of this passive money is invested into indices like the S&P 500, pushing their prices even higher. And this, of course, begs the question, of why the US government is practically forcing people to buy US assets in a very secretive way. Before we dive into the answer, if you're enjoying what you're learning so far, then sign up for our free weekly newsletter and check out some of our finance-related deals exclusively for the viewers of this channel. Just click the link in the description or scan this QR code. You don't want to miss what we have on offer. Back to the video. Now, to quickly recap, passive investing strategies overtook active investing strategies in 2005, and these passive strategies manage more assets than active strategies as of 2024. Put the two together, and it means that passive investing strategies have become one of the biggest drivers of price action in major assets and indices, especially in the US, and particularly over the long term. As I explained a few moments ago, the rise of passive investing wasn't just done for logical reasons. It has been mandated by the US government. And if you've been keeping up with the headlines, you'll know that another mandate was included in the Big Beautiful Bill passed by the Trump administration earlier this year. Every newborn US citizen will automatically get a savings account starting July 2026. But again, why is the US government practically forcing people to buy US assets in a very secretive way? And the answer should be obvious when you remember where most passive investing actually comes from: savings for retirement. Now, for context, most Americans retire around the age of 65. The exact number does depend on your source. In any case, in case you missed the news, the US hit peak 65 in 2024. As the name would suggest, peak 65 refers to a period where the greatest number of Americans are turning 65. It's a period that is expected to last from 2024 until 2027, and each year, over 4.1 million Americans will be turning 65 each year, with most of them being likely to retire. And when you recall that many of these people have retirement savings plans heavily invested in US assets, you realize the glaring problem. Put simply, tens of millions of baby boomers in the US are starting to sell US assets to fund their retirements, and will be doing so at an increasing pace in the next few years. Now, for reference, over half of the US stock market is held by baby boomers, which is frankly mind-blowing. And in case you didn't know, it's standard practice to rotate from stocks into bonds as you age to preserve your existing capital. What this means is that hundreds of billions of dollars of US stocks will be sold by baby boomers in the coming years. Unless someone steps in with more buying pressure, then the US stock market could shrivel up and die as boomers suck out all of the wealth to fund their retirements. The catch is that any boomers who sold too late would be left holding the bag, and we can't have that. So the US government came up with a very clever idea: siphon money from people who are entering the workforce through automatic contribution plans, which are mandatory as of 2025. The good news is that you can still opt out for now. The bad news is that this money will be siphoned from newborn Americans by default starting July 2026. And what's wild is that it will come from the US government. To be exact, the US Treasury will automatically put $1,000 into each so-called Trump account of newborn babies in the US starting July 2026. Well, certain newborns, but let's not get into that. In addition, parents, relatives, and friends of each child will be able to add up to $5,000 per year into this Trump account. And not only that, but even the parents' employers will be able to contribute $2.5K per year. Now, some of you might actually have heard about how Dell Technologies founder and CEO Michael Dell announced that he and his wife will be donating $6 billion to help fund these Trump accounts. What you may not have heard about, though, was that Dell Technologies also announced it would also give a one-time contribution of $1,000 to Trump accounts of their employees' children. And to clarify, yes, there can be external contributions too. Regardless, when you consider that having kids in the US costs a lot of money, it's safe to assume that there will be at least an additional contribution of $1,000 to Trump accounts of newly born children by parents and/or relatives and/or friends in the first few years. And this is even more likely when you consider the additional matching programs by some employers and donations by some philanthropists. And this just leaves one missing number in our equation: the number of children who will be eligible for Trump accounts in the coming years. Now, when you consider that children born in 2025 will also be eligible for Trump accounts, you end up with close to 5.5 million children who will get around $2,000 in their Trump accounts on the 4th of July 2026. That's $11 billion that will be instantly injected into the US stock market. And more importantly, that's $11 billion that the boomers will be able to suck out without affecting stock prices. And after the 4th of July 2026, you'll have around 10,000 babies born each day, while around 11,000 boomers retire each day, helping to offset their selling pressure on an almost perfect one-to-one basis. And all of this, ladies and gentlemen, is just the tip of the passive income iceberg. As it so happens, an iceberg is an almost perfect way to explain passive investment flows, though an upside-down triangle would probably work better, but whatever the case. Starting at the very top, we have all of the flows going into US assets, stocks, and bonds. And of these total flows, a staggering 80 to 85% come from passive investing strategies. 80 to 85 cents of every dollar invested in US assets is passive. I'll just quickly note that this data is hard to pin down, and it can vary depending slightly on your source. Anyways, of the passive flows into US stocks and bonds, a whopping 73% of passive flows go into stocks versus 27% which go into bonds. As a fun fact, this is because of the 60-40 allocation I mentioned earlier. The caveat is that the exact allocation depends on your age. The younger you are, the more passive flows go towards stocks, and the older you are, the more passive flows go towards bonds, if that wasn't already clear. Anyhow, of the 73% of passive flows that go into stocks, around 70% go into the S&P 500, and the result is that around a quarter of the S&P 500 is held by passive investment strategies. In turn, around 40% of every dollar invested into the S&P 500 from active or passive investors goes into the top 10 stocks. And since the S&P 500 determines this weight based on market cap, larger companies get larger weights over time. To put things into perspective, S&P 500 concentration is the highest it's been in recent history. At first glance, you might think that this means there must be some rebalancing or reversion to the mean that results in larger stocks in the S&P 500 falling in weight and smaller ones rising in weight. Upon closer inspection, specifically of the passive flows, you realize this concentration will only get worse. And that's just because passive investing strategies automatically buy assets when new money comes in, whether from 401k retirement plans for employees or Trump accounts for newborns. And as I just explained, 73% of every dollar allocated to passive investing strategies goes into stocks, with 70% of that going into the S&P 500. So long as people are working or being born, passive investors will keep steadily buying. Macro analyst and investment manager Mike Green refers to this mechanism as the, quote, giant mindless robot. And after decades of actively analyzing the stock market, he's come to the very sobering conclusion that there's only one way to beat the market. Buy the S&P 500 with leverage, namely the largest stocks in the index. There's no use looking for value when most flows are going into these assets. And I'll repeat that nothing in this video is financial advice. That's just Mike's conclusion. Now, this begs a bigger question, and that's, if these flows go in reverse, when could they go in reverse, and how would that affect the markets? The answer should be obvious again to anyone who's been paying attention, at least some of the answers. And these include baby boomers retiring and rotating out of stocks into bonds or just selling outright, unemployment rising sharply, or fewer people being born. And as we've learned, baby boomers retiring and shifting or offloading assets has apparently been on the minds of politicians for decades, which makes sense given that many of them are also boomers. The outcome has been the passing of acts and mandates such as the aptly named Pension Protection Act of 2006, the more subtle Secure 2.0 Act of 2022, and the more bombastic Trump accounts. In a sense, you could say that the purpose of the Pension Protection Act is to keep the pension of boomers protected. The true purpose of the Secure Act is to keep the pensions of boomers secure, and the true purpose of the Trump accounts are to ensure that the pension accounts of boomers are funded. And these acts and mandates seem to be purposely made to offset the selling of boomers. There's just one small problem, and that's that the number of layoffs in the US is growing, and new US graduates are having a harder time finding work. If you want the numbers, around 1.3 million Americans will lose their jobs this year compared to 760,000 in 2024, and around 33% of graduates are having a hard time finding work compared to 20% in 2024. Less employment means less passive flows. And never mind the fact that the number of births eligible for Trump accounts has been declining too. That said, this will be offset partially, if not mostly, by Trump accounts, at least on paper, meaning that passive inflows coming from newborns should help outweigh passive outflows coming from retirees when combined with defined contribution plans. In practice, it might not be enough, but if that's the case, the US government would step in to assist. And that's just because it's estimated that half of the boomers are relying on the US stock market to retire, and boomers make up a third of the voter base, as well as over 40% of congressional seats. Failing to step in to save the boomers would therefore be political suicide for any party that refused. And that's precisely why we've seen these passive investing mandates and acts introduced by both parties. So this once again begs the question, what would cause these passive flows to go in reverse, when would they go in reverse, and how would this affect the markets? If rising unemployment, fall in birth rates, and even boomers retiring aren't the likely answers, are there any others? From Mike Green's perspective, there's only one, an exogenous shock that suddenly turns all these passive flows into active flows. You see, Mike's argument is investors are only passive when everything is fine, relatively speaking. So long as there are no pandemics or wars or other sorts of crises, most passive investors don't even think about their portfolios or their allocations. It's only when an exogenous shock hits that passive investors start to panic and sell. Notably, this exogenous shock must be large enough to cause a big drop in the markets. And now that you understand how most passive flows go into stocks, you realize that when the S&P 500 drops 5 to 10%, it means that the average passive investor has a substantial unrealized loss on their overall portfolio. And if this passive investor happens to be part of the Peak 65 group, i.e. someone who's close to retirement, this means risking losing a substantial percentage of their wealth for the rest of their life. The prospect of losing more than a few percentage points is therefore unbearable for many of these passive investors, which is precisely why you see so much panic when the S&P 500 falls by a few percentage points in an objectively standard pullback. Come to think of it, it's probably no coincidence that the level of panic during dips has risen consistently since 2024, and that's when Peak 65 began, mass retirements. So what would happen if we were to see a true exogenous shock, such as, say, China invading Taiwan? The S&P 500 would implode, mainly because it's so heavily concentrated in tech stocks. And this would initially be due to longs being liquidated and active investors and algorithms selling out of caution or panic. It would take a few days for most passive investors to get up to speed on what's going on. After seeing markets down 20 to 30% and their current and or future net worths down by similar percentages, many would decide to sell, and this is where Mike's giant mindless robot of passive investing comes back into the picture. To refresh your memory, the giant mindless robot will automatically buy assets when money comes in, with 73% of every dollar going into stocks and 27% going into bonds. Now consider what happens when the giant mindless robot is told to sell by panicked passive investors who have suddenly become active. 73% of every dollar they request comes from selling stocks, mostly the S&P 500, and mostly the large tech stocks which happen to be the most affected by this exogenous shock. And this causes markets to fall even more, liquidating more longs and causing more active investors to sell. And this is exactly what happened earlier this year with Trump's Liberation Day tariffs. The S&P 500 fell by over 20% in just a few weeks as boomers who actively watch mainstream media pundits like Jim Cramer were told that lower lows were coming, and the US economy was headed for a brutal recession. But, as we all know, that didn't happen. The markets bounced back and the passive flows returned. And this begs the biggest question of all. What saved the markets from completely imploding from panic selling by passive investors after Trump's Liberation Day tariffs? Aside from the fact that Trump decided to pause the tariffs in response to the market chaos, active retail investors who are aware of the insane market situation realized that the markets would not be allowed to fall because of all the boomers. Put differently, active retail investors realized that the US government would step in to prevent stocks from falling further because of the dynamics we've discussed throughout the entire video. Most baby boomers are directly or indirectly dependent on the stock market for retirement, so it can't be allowed to fall. So retail investors just took a page out of Mike's playbook. Just buy the top stocks in the S&P 500. Before you ask, no, this doesn't mean that the US stock market can never have a sustained bear market where prices continue falling for months on end. All it means is that the exogenous shock required to cause the US stock market to have a sustained fall must be so extreme that retail investors are too scared to buy the dip, and nothing the US government does is enough to reassure the passive investors. So now I ask you, is there an exogenous shock that could meet this criterion in the foreseeable future? If so, what could it be, and when could it happen? If you have the answer, drop it down in the comments below. It'll be fascinating to see your predictions. And one possible answer could be a global economic collapse, which is exactly what we discussed in a recent video, which you can find right here. And if you made it this far, thank you so much for watching. This is Nick signing off, and I'll see you in the next one.